Dear students and viewers, I welcome you with another exam style question on the subject of economics. This question will test your knowledge and make you learn the concept of a command economy. Zenith School of Accountancy is committed to providing free learning to students from all walks of life. To watch other exam style videos, please explore my channel's playlist. Please also subscribe to my channel to stay informed about new videos. Today's question is: in a command economy, the economic problem of deciding what goods to produce is decided mainly by option A, relative prices, option B, profit levels, option C, state direction, option D, shadow prices. To correctly answer this question, you must understand all the four options provided in the question. Let me explain these options one by one. Option A, relative prices. A relative price is the price of a commodity such as a good or service in terms of another, that is, the ratio of two prices. A relative price may be expressed in terms of a ratio between the prices of any two goods or the ratio between the price of one good and the price of a market basket of goods. A simple example will explain it. Suppose the nominal price of 1 liter of milk of brand X is $2, while the price of 1 liter of milk of brand Y is $2.25. In this case, the relative price of 1 liter of milk of brand Y will be calculated as by dividing $2.25 with $2 and multiplying the result with 100. And this will give us a value of 112.50, implying that brand Y is 12.5% more expensive than brand X. Option B, profit levels. A profit margin or level is a financial ratio that measures the percentage of profit earned by a company on the sale of its goods and services in relation to the revenue generated from the sales. Suppose a company sells product A at the rate of $25 per unit and product B at the rate of $30 per unit. We also assume that the cost of sales of product A is $15 per unit, while that of product B is $20. Therefore, the profit per unit for product A will be the difference between selling price of $25 and cost of sales of $15. That is $10 per unit. In percentage terms, the profit level or margin on product A will be calculated as 10 divided by 25 multiplied by 100, and this is equal to 40%. Similarly, in the case of product B, the profit will be the difference of selling price of $30 and cost of sales of $20, that is $10 per unit, same as of product A. However, in percentage terms, the profit level or margin on product B will be calculated as $10 divided by 30 multiplied by 100. This will give us a result of 33.33%. So although both the products have the same profit per unit of $10, but the profit level of product A is higher, that is 40%, when compared with the profit level of product B, that is only 33.33%. Therefore, profit levels compare the profit in relative terms to make it clear which product earns a higher profit margin. Option C, state direction. A state direction is the process whereby the governments control and regulate the economic process in a country. The crucial questions of what to produce, how to produce, and for whom to produce are decided by the political will of the government instead of the price mechanism as is done in a capitalist or free market economy. The government sets the prices of goods and services and the quantities to be produced. The classic examples of a command economy may be Cuba, North Korea, or former USSR. Option D, shadow prices. A shadow price is an estimated price for something that is not normally priced or sold in the market. In the business world, companies may use shadow prices to transfer goods produced by one division to another division to determine whether it is feasible to produce internally or buy it from an outside source. Therefore, shadow pricing can provide businesses with a better understanding of the costs and benefits associated with a project. For example, if a production line is already operating at its maximum 40-hour limit, the shadow price would be the maximum price the manager would be willing to pay for operating it for an additional hour based on the benefits he would get from this change. Based on the explanation provided by me, you know that the correct answer is option C. That is, in a command economy, the economic problem of deciding what goods to produce is decided mainly by state direction. If you enjoyed this video, please do subscribe to my channel. Click the bell icon for notifications and also share and like this video. Thank you for watching.